Welcome back. Well, the good news is that we aren't sliding anymore. Things seem to be stable for what it's worth, 19,150 thereabouts. That's where the market has tried to form some sort of a base, at least for the time being. Let's keep the conversation going. We have our next guest now joining in, Vinay Jaisingh, who's the MD Portfolio Management Services at JM Financial. Vinay, thanks for joining in. Interesting times. It seems that suddenly from going to a consolidating market, a market that's just seeing some time correction, now there's a bit of a worry on the street, specifically with respect to mid caps and small caps. What have you made of the shakeout we've seen over the last 2 days?
A couple of things, Firstly, the shakeout is largely a function of what's happening globally. You've seen the US debt market, you've seen the interest rates there surge to 5%. It's corrected a bit to 4.8 now, the 10-year yield, but you're also seeing interest rates for the longer term inch up in US and remain high for long. Now, this is a 15-year high which US has witnessed. What we're hearing is, be it the mortgage industry in US, be it the student education loans of US, both of them have more than tripled because of what's happening in the interest rates out there. The good news there is the fiscal deficit is increasing, as a result of which you're not seeing the GDP correct. And you have at one end a high interest rate environment, at the other hand, the government spending. So you're not seeing as much pain for companies. The concern which has seeped in the last couple of days has been, what if the government of US in the next year starts reducing the fiscal aid which it's giving, or starts increasing the deficit, reducing the deficit? What would happen with that is then the pain would start hitting the companies a lot more. And that concern now, though it's largely US-centric, is revolving to the rest of the world. India, being the best performing market, FYTD, has seen the last few days found it a little tougher to do well on the bourses. They're down 2%. Obviously, the small cap and mid cap, which are up as much as 35% FYTD, or a little bit more YTD, they've seen a shave off of almost 3 to 5%. So it's more a correction. In our eyes, it's a healthy correction. This is the time when, when we had put some money which we had saved, let's say 8% out of our portfolio, we got to start looking at what in mid cap, what in small cap, or what in any cap looks attractive. Now that yield of interest which you had in the small and mid cap, the dividend yield is not different compared to the large cap. So for us now, it's just individual stocks. We like the capex sector, so individual stocks, be it in small, mid, or large, we start nibbling in, or wait a little bit more for corrections. So for us, really the view is don't look at any caps as of now. But don't forget, India is really doing very well on the earnings front. Whatever results we've come apart from rural India, your earnings growth trajectory is still on the 15% plus mark year on year. That sounds great. Also, don't forget the dollars which India has, the forex reserves are pretty strong. So overall, apart from the current account deficit, things look a lot more robust for India compared to the rest of the world.
You mentioned rural. Vinay, hi, good afternoon. Look at levers. I think volume growth for the last 3 years, I think no volume growth, right?
But, absolutely.
Again, in rural, you got to, I guess, pick pockets. So what are you adding to what you already own? Because I have a bunch of things that you do own. Are you looking at newer things? Just give us a flavor, Vinay.
Sure. So we largely, we are negative on rural. As you said, levers results have not been as good as we wanted it to be. We are not seeing a volume growth of more than 2-3%. So we're keeping our eyes open in the rural space. But what we are adding to are, companies in the capex sector, which have partly corrected, but the results are pretty exciting. Be it companies like Kirloskar Oil, be it companies like Vatek Wabag, wherein the earnings as well as the valuation is going your way. We're looking at some pharma names like Concor Biotech, which is very resilient again to earnings for the rest of the world, because it's a market leader both in global as well as domestic. Domestically, it has a market share of 40 to 50% in immunosuppressant. So these are the names we are looking at. One company in the financial space where we are looking, and we've added a weightage a lot in the financial space in the large cap, but in the mid cap or micro cap is Fusion. A good MFI with a 5% plus ROE. So I think there are lots of good names where the earnings growth trajectory are rock solid, and those are the names we are focused on. Also, this is the time wherein we think valuations in some stocks have hit the roof. We're correcting some of them. Some risks which we see from China, we've reduced a little bit of position in the specialty chemical space. So, we have a kitty of 8 to 10% to invest.
So,
8 to 10% to invest. Is this the most that you've kept in the recent past? Would you look to up your cash exposure?
Even in the last month, we had a similar kitty, but, we took out some specialty chemical names and bought some. So it's more or less been at the same level. We don't like going north of 10%. So it's close to the most we would keep as cash in hand.
okay. Vinay, so you mentioned, for instance, you're a little cautious in areas like chemicals, and that's completely understandable given the way a lot of the global companies have been pruning their guidance, right? If you were to start shopping in this fall, first of all, is it time, or should one still wait it out and let things settle? But if you were to go out with your shopping list, what areas are you looking at now? Specifically, I'm talking about mid caps and small caps.
Right. So, let's start with the chemical space first in mid caps and small caps. Though we say chemicals as a whole basket, you got to look at those chemicals which are not linked to China, where China is not producing the product or the raw material. And then you will get companies like, let's say, Tatva Chintan, which actually are selling products to China for their CV, which are also tomorrow's story for EV. They're also focused on flame retardant. So, some spaces out there. In CapEx, when we are looking at railways, we've got interesting order books growing for lots of companies. I think that entire sector, if you see any correction, you got to choose any of the picks. All of them have earnings growth trajectory of 25 to 30%. All of them happen to be mid cap or small cap. In defense as well, you will see earnings of some of the companies not being as attractive, largely because they've not got the supplies from the rest of the world to finally send the products. But companies like Bharat Dynamics, their order book is real. They have to execute. It's a matter of whether it executes this quarter or next quarter. The return ratios are rock solid at about 20%. So if they miss 1 or 2 quarters earnings, what that means is in the next 3 years, the earnings growth could be as much as 45 to 50%. So there are enough of mid and small cap names, which we are looking at.
Vinay, have you looked at Dream Folks as a business? I think...
No, sorry.
No, you're not. Okay, I just wanted your thoughts on Fusion. You own that. You mentioned that. It's kind of not done very much for the last at least couple of months. Even of course had a big run earlier. Is that the best name in the microfinance space, or is it the cheapest with the best growth? Is the valuation growth combination, or many like Credit Access for a very high quality MFI again? But your thoughts?
So I think, as you said, it's more a function of the best value for money. It's trading at 1.7 times price to book, 5% ROA. It's had a historic loan book growth of about 35%. And, our analyst tells us a 25% growth rate in the next 3 years is something which she's very comfortable at. Also, the capital adequacy ratio is north of 23, 24%. So they don't need to come to the market to raise rates. So this is something which I think on a risk adjusted basis makes a lot more sense for us than most of the other MFI names.
Okay, got that. We'll leave it there, Vinay, for now. Appreciate you joining in with that perspective. Thank you very much for joining us, and happy shopping. I was to